biggest macroeconomic feature of the coming week, aside from the issue of Brexit, could be the latest monetary policy decision from the US Federal Reserve on Thursday the 31st of October. Now, as I sit here, the financial markets are pricing in a 72% chance of a 1/4 point interest rate cut. That would be the third such reduction of this year, and it would take the top end of the Fed's target range to 1.75%. Note that the Fed has also restarted its bond buying program at around $60 billion a month, although Chair Fed Powell is swearing blind that this is not quantitative easing. He says instead it's to smooth liquidity in the interbank lending or repo market. But he's only doing that because the overnight cost of borrowing spiked in September to nearly 10%, so the move is designed to control interest rates and borrowing costs. So, if it looks like a duck, sounds like a duck, and walks like a duck, well then we've probably got, you guessed it. Whether you think though or care this is QE or not, the Fed is intervening in financial markets again. You therefore need to think why they're doing it and whether this may be a good or a bad thing. Back on the domestic front, there'll be plenty of corporate news to study since a broad range of large, mid and small cap companies are scheduled to release interim full year results or a trading update. They include HSBC on Monday the 28th of October, Bloomsbury Publishing on the 29th, GlaxoSmithKline, Standard Chartered, Next and Smurfit Kappa on the 30th, Lloyds, BT, Royal Dutch Shell and International Consolidated Airlines as well as Smith & Nephew on Thursday the 31st. But the company which could really cause the biggest fuss for me in the week ahead might just be BP. The oil major is due to publish its third quarter results on Tuesday the 29th of October, and that will follow on from the recent announcement that Chief Executive Bob Dudley will step down after more than 9 years in the job in February 2020. His replacement will be Bernard Looney, who currently runs the upstream business, which means exploration and production. Now, as we can see in this next graphic, BP shares have gone nowhere fast over the past year. If anything, they've seeped slightly lower, largely due to a fall in oil prices. I should also note, however, that the natural gas price has actually collapsed from around $3.30 per million British thermal units a year ago to barely $2.30 now. That's largely due to a glut of supply coming out of America's onshore shale fields. We can see the net impact of this in the next graphic, which shows total growth in hydrocarbon production at BP against the change in total prices received on a year-over-year basis. Now in Q3 2018, BP's production was 3.6 million barrels of oil equivalent a day, and it got on average $46.1 a barrel, $69.68 for oil and $3.86 for gas. The dip in Q2 helped to explain why the headline replacement profit cost figures dipped year on year at BP on a stated and an underlying basis. Now, just so you've got a base for comparison for Q3 this year, BP's stated replacement cost profit a year ago was $5.8 billion and underlying profits were $6.7 billion. Upstream, oil production, made $3.5 billion and downstream, that's refining and petrol stations, it made $2.2 billion. Now, after those headline numbers, analysts will focus on cash flow because it's cash flow that pays the all-important dividends. The dividend, currently running at 10.25 US cents a quarter, puts BP stock on a yield of more than 6.5% at the moment, and BP is the third highest dividend payer in sterling terms in the FTSE 100 for 2019, according to analysts' consensus forecasts. In actual total cash terms, the dividend comes in at around 1.6 to 1.7 billion US dollars a quarter. The good news is that BP's cash flow has covered that 4 times in the last 5 quarters. Throw in disposal proceeds, borrowings, and cash raised has covered the divvy 9 times in the past 12 reporting periods. However, analysts will be looking at BP's debt, not least because you don't want any company relying on disposals and debt to fund its dividend for long, or really at all. That weakens its competitive position and its ability to invest over the long term. There is no need to press the alarm button at BP yet, but net debt has crept high to $46.9 billion, thanks in part to 2018's acquisition of shale oil and gas assets from BHP in America for $10.5 billion. it'd be nice to see this figure start to come down, and BP has already declared it's finished its $10 billion disposal programme ahead of schedule. Thank you for watching, and I look forward to seeing you next time.